Welcome to the deep dive. Our mission today, well, it's pretty huge. We're diving into this really fascinating collection of sources, all focused on where immense personal wealth, massive ambition, and real global influence collide.
That's it, exactly. We're looking at the architects of modern power. And these sources, they cover a lot of ground. We go from 19th century industrialists all the way up to today's tech titans.
Right.
And what you see is this incredibly complex picture, uh, how the decisions of just a few individuals, their strategies, their personal drives, their financial power, how that's really shaped, well, everything, economies, markets, society itself.
So, for you listening, the goal here is key. We want to quickly pull out the core strategies these people used. How did they build and then use this world-changing power? Across industry, finance, tech, we're trying to get past the myths, cut straight to the nitty-gritty, the material reality of how this power actually worked. It's about spotting that thread of ambition, right, through different times. Okay, let's get into it. Starting really where modern American capital began. Okay, so we start with the originals, right? The American giants, Andrew Carnegie and John D. Rockefeller Sr. These guys practically invented the playbook for being massively wealthy. Carnegie even called it the gospel of wealth. But the sources show this deep conflict, almost a contradiction right at the heart of it.
It's fascinating, yeah. Carnegie built his whole intellectual justification. He argued that letting guys like him get and keep huge fortunes was actually best for society. Why? Because the retired capitalist, acting as a, quote, trustee and agent for his poorer brethren, would give it away wisely.
So he's saying only the super rich have the wisdom to manage wealth for everyone else, like a kind of economic nobility.
Pretty much. His argument rested on their superior wisdom, experience, and ability. It does sound a bit like, a divine right of capital.
Okay, that's the philosophy. Sounds noble, almost. But then you look at how he actually operated. The sources detail this relentless drive for profit, especially when it came to labor, like that dispute at the Edgar Thomson works in late 1890.
Right. Carnegie knew the workers wanted a raise, and he wrote straight up to his partner, Henry Clay Frick, quote, any advance of wages these times is out of the question.
Wow.
His calculation was purely strategic. He figured the workers would be desperate enough to take the old wages, even if they wouldn't get paid till spring, just to keep the mills open and stay employed.
That's pretty ruthless.
And that inflexibility, it just hardened. It led directly to the awful homestead crisis. Carnegie's priority wasn't just saving money short term. He was about establishing total, non-union control over wages, setting a precedent.
He actually wrote to Frick, didn't he? Something like, dollars don't count.
Exactly. In a postscript, he wrote, dollars don't count, let pecuniary considerations go. Victory was everything. He insisted the works had to be totally reorganized. Workers needed to seek work elsewhere. No use waiting. They will melt away like snow in the summer.
So the goal wasn't just winning the strike. It was crushing the union, establishing permanent control. That whole wise stewardship idea kind of falls apart there, doesn't it?
It evaporates the second labor challenges management.
Yeah.
That absolute control, that's the link to John D. Rockefeller Sr. He had a different kind of ruthlessness, maybe. One based on this almost unsettling precision.
Yeah, the sources talk about him being meticulous, even as a kid, with his religion, his money.
If he pledged 15 cents to the church, the sources say he was always very precise about it, couldn't be moved to give a penny more or a penny less.
Okay, so he's methodical.
And that carries right over into business. He always dealt with people on his terms, on his turf. And the key to Standard Oil's takeover in Cleveland, it was pure leverage, especially with transportation. The South Improvement Company, that wasn't really a company.
It was more like a mechanism, right, for getting secret rebates from the railroads.
Exactly. And the pressure that put on competitors was immense, existential, really. We have quotes from refiners saying, if you didn't join Rockefeller's scheme, you were, quote, virtually killed as refiners.
A death sentence, not just competition.
He later tried to spin it as self-defense, saying the oil business was chaotic. But the reality was, he built a massive monopoly by controlling the essential infrastructure, the plumbing of the industry.
It's important to remember, though, these guys didn't do it alone. Rockefeller himself, he gave huge credit to his associate, Henry Flagler.
He did, attributed his own pecuniary success directly to Flagler, saying Flagler ranged even farther afield than he did. It shows that even these dominant figures, they relied heavily on key people, on strategic partners. Flagler was the one making the logistics control happen.
That's a really good point, the hidden figures behind the throne, so to speak. Okay, let's switch gears a bit to Henry Ford. His ambition didn't just build a company, it fundamentally changed how we think about work and, well, buying stuff.
Yeah, Ford's story has this deep, kind of tragic irony. He really seemed to believe you could mass-produce people just like cars.
What do you mean?
Well, his foreman, Sorensen, was apparently horrified by how soul-crushing the assembly line work was. Just repetitive, endless.
Yeah.
Ford's response, if the workers can't or won't do it, just, quote, make some more men for these jobs.
Yeah. Disposable. Interchangeable.
Totally. And that belief that human labor is just another input, it was, well, inhumane. But it also transformed culture by stripping the joy, sense of accomplishment, and moral meaning out of making things.
He accidentally made consuming things the main goal.
Exactly. The Model T, the thing being produced, that became the symbol of happiness, of achievement in America, not the act of producing it. It shifted the whole idea of the American dream from being a productive worker to being a successful consumer. That's a massive legacy.
Huge. And yet, even inside Ford, there was pushback against his total autocratic style. He was known for being impulsive, not really explaining his reasoning.
Right. But his son, Edsel, apparently preferred a totally different style, cooperative, team-oriented management. The sources say a lot of managers actually stuck around, hoping Edsel would take over eventually.
Why?
Because, quote, you could reason with Edsel. You couldn't reason with Edsel's father. That tension, between the single strong leader and the collaborative team, that's a pattern we see again and again right up to Silicon Valley. Okay, so that idea of structured, systematic control, it moves from the factory floor into the much more abstract world of global finance. And this is where we really see wealth concentration patterns start to diverge and get much more intense. Thomas Piketty's work really lays this out.
Right, Piketty. This is fascinating stuff, but we need to unpack it carefully. He talks about U-shaped curves for inequality, right?
Yeah.
It goes down for a bit in the mid-20th century, then shoots back up from the 70s onwards.
Correct. But the crucial point he makes is that the reasons for that upward curve, the things driving it, are different in different places.
Okay, explain that distinction.
In the U.S., that divergence, the widening gap since the 70s, it's mostly about income inequality. So think huge salaries, massive bonuses for top executives, financiers, superstars. They're taking a much bigger slice of the overall labor income pie.
Got it. So high earners getting higher earnings. What about Europe?
In Europe, it's different. The divergence there is driven more by the capital income ratio. That means the sheer value of existing wealth-inherited fortunes, accumulated assets, and the returns on that capital are growing faster than the economy itself. That's what's pulling the wealthy further ahead.
So U.S. super salaries. Europe. The power of old money compounding.
That's a good way to put it. And you see this clearly when you compare the Anglo-Saxon countries, U.S., U.K., Canada, Australia, with continental Europe and Japan.
How so?
In those Anglo countries, the share of total income going to the top 1% just exploded upwards from the 1970s. But in places like France or Japan, the increase was much smaller. Their top 1% share went from maybe 7% in the 80s to around 9% today. Still an increase, but nothing like the scale you see in the U.S. or U.K.
Which suggests different policies, different social safety nets, maybe?
Exactly. It points to differences in tax policy, regulation, maybe even cultural norms around wealth concentration. And speaking of wealth, the influence of inherited wealth is just staggering historically.
Yeah. The sources say back in the 19th and early 20th centuries, something like 80 to 90% of all private wealth was inherited.
Incredible, isn't it? And even now, Piketty notes that while fortunes can be hit by random shocks, bad investments, family feuds, a kid who spends it all, the underlying tendency is for wealth distribution to gravitate back towards an equilibrium that strongly favors those who already have it. The system sort of preserves itself.
And taxes don't always fix that. You mentioned something counterintuitive.
Right. Piketty finds that in many European countries, the overall tax system can actually become regressive at the very top.
Hang on, regressive, meaning the super rich pay a lower effective rate than the middle class. How does that even work?
It comes down to what kind of income they have. Middle-class folks mostly earn wages, right? Subject to progressive income tax rates, which get higher as you earn more. But for the ultra-rich, the top 0.1%, a huge chunk of their income isn't wages. It's capital income dividends, interest, capital gains.
And that's taxed differently?
Often, yes. In many places, capital income faces lower rates or it's exempt from the progressive structure altogether. The sources mention France, where the top 0.1% might pay an overall rate of just 35%, while middle-class earners could be paying 45 or 50% on their labor income. Wealth itself provides a legal shield through the tax code.
Wow. So if the rules basically favor keeping wealth, it's maybe not surprising that you see people pushing the boundaries, using aggressive financial tactics. Like Michael Milken, the junk bond king, backing Ivan Beresky.
That's a prime example. Milken apparently brushed off all the warnings about Beresky, just insisted, quote, Drexel backs winners and Beresky's a winner. Now, Beresky was an arbitrager.
Profiting from tiny price differences in stocks, often around mergers.
Exactly. But the key thing here is Milken didn't just fund Beresky. He demanded a personal equity stake in Beresky's operation.
Ah, so their fates were tied together financially.
Precisely. It massively increased Milken's incentive to make sure Beresky succeeded, which, raised huge questions about sharing inside information. It was a core part of the whole junk bond ecosystem's rise and eventual fall.
And when it all came crashing down, the legal deals were revealing too.
Very much so. There was this crucial difference in the plea bargains. Milken's deal was structured so it would hold up, even if he lied while cooperating with prosecutors. But Beresky's deal and Martin Siegel's, they were revocable. If they lied, their deals were off.
So Beresky and Siegel had a much stronger incentive to tell the truth.
Inherently, yes. Their credibility with prosecutors was higher because they had more to lose. Milken's deal protected him more, reducing his need to be fully transparent, a strategic masterstroke in legal maneuvering, really.
That high-stakes culture, it bleeds into the LBO craze leveraged buyouts. Buying companies with tons of borrowed money, often those junk bonds. RJR Nabisco is the famous one.
Right. And the trigger there was fascinating. RJR Nabisco's profits were up 50%, but the stock price was tanking. Why? Because the market hated the tobacco part of the business.
So they came up with a financial fix?
An internal idea, yeah, to create a separate F stock, just for the food assets. Try to visually and financially split the attractive food business from the problematic tobacco side, hoping the market would value the food part higher on its own.
Like financial engineering to boost the stock price.
Exactly. It echoed what General Motors had done years before with different stock classes for different divisions. And the pressure in that era, and especially in later crises like 2008, it was just immense. You quoted Hank Paulson earlier.
Yeah, the Treasury Secretary during the 2008 meltdown, basically threatening bankers, telling them, we will remember anyone who is not seen as helpful. Chilling.
It really is. Imagine that level of pressure, cooperate, or face potential ruin. It obliterated normal business logic. Even firms doing okay were panicking. John Mack at Morgan Stanley was reportedly furious about a headline saying, Goldman, Morgan now stand alone, even though Morgan Stanley had just posted good profits.
The crisis itself became the only reality that mattered.
Fundamentals went out the window. It was all about survival and perception.
Okay, let's shift to the more recent plumbing of finance, high-frequency trading, HFT. This isn't buyouts. This is about speed, algorithms, milliseconds.
Yeah, this is where Wall Street basically merges with Silicon Valley.
Yeah.
Take a firm like D.E. Shaw. They didn't see themselves just as a hedge fund. They called themselves a versatile technology laboratory, applying computer science to investing.
And wasn't Jeff Bezos involved there early on?
He was. In 1994, they picked Bezos to lead their first big push into internet-related ventures. That shows you their mindset. It was about finding technological edges, technical arbitrage, not traditional stock picking.
So what does all this speed and tech mean for, say, a regular person's pension fund trying to buy stock? Are they getting a fair deal?
That's where IEX comes in the investors' exchange. It was set up specifically to fight predatory HFT.
Yeah.
And their findings were pretty damning.
What did they find?
They tracked orders. When Goldman Sachs sent orders to IEX and left them there for 10 seconds or more, 92% traded at the midpoint, basically the fair price between buy and sell offers, 92%.
Okay, sounds fair.
Now compare that to Wall Street's private trading venues, the so-called dark pools. When orders went there, only 17% traded at the midpoint.
17, wow, that's a huge difference.
It showed that the system, the market's plumbing, had been deliberately complicated. HFT firms operating in those dark pools could use their speed advantage to effectively see incoming orders and jump ahead of them front-running. They could buy shares fractions of a second before a big institutional order hit, then sell them to that institution at a slightly higher price.
So the complexity wasn't an accident. It was designed to allow skimming.
That's what the IEX data strongly suggested. Fairness was possible, but the structure allowed for, let's say, technologically enabled opportunism on a massive scale.
Okay, fast forward firmly into the 21st century. We're in the age of the tech titan now. And these figures, they didn't just build companies, they built new operating systems for how we live, how society works, often through sheer audacity and relentless efficiency.
The classic starting point is Bill Gates, right? That famous IBM deal. The sources highlight how IBM basically outsourced the problem of finding an operating system for their new PC to Microsoft.
They made it Microsoft's problem to solve.
Exactly. A brilliant negotiating move by Gates, really. It led him to acquire the system Tim Patterson had built at Seattle Computer Products. Gates was a master at spotting and leveraging existing assets, turning IBM's lack of vision into Microsoft's global dominance.
Then you have Steve Jobs. Very different style. Less about deals, more about imposing his personal vision, sometimes quite brutally.
Yeah, Joni Ive, Apple's design chief, described how Jobs would initially just dismiss ideas, shoot them down. Then, later, he'd be talking about the same idea as if it was his idea.
The famous reality distortion feel.
Right. But I've also admitted that Jobs' let's call it, tyrannical drive was absolutely necessary. He was the force needed to drive through all the resistance, internal politics, engineering challenges, to actually get those groundbreaking products made. Without him, they probably wouldn't have happened.
That force of personality, it shows up in hiring, too. Look at Jeff Bezos at Amazon. He had this really demanding standard for bringing people in.
Absolutely. His core philosophy was that every single new hire had to raise the bar for the next hire. Imagine that pressure cooker constantly escalating the level of talent and expectation.
And he used weird interview questions. Right?
Yeah, those abstract brain teasers like how many gas stations are in the United States. Not really about the right answer, but testing how you think under pressure, how you break down a problem.
And he specifically didn't want people looking for work-life balance.
The sources are pretty clear on that. He apparently rejected candidates who wanted a, quote, harmonious balance between work and home life. The implication was, at Amazon, especially early on, work was your life. It reflected his own total commitment.
That relentless drive for efficiency in tech, it can get pretty cold. The sources mention Uber.
Oh, yeah. This is like Ford's assembly line logic, but applied to hiring knowledge workers.
Yeah.
Uber executives actually designed an algorithm.
An algorithm for salaries.
To figure out the lowest possible salary a specific candidate would likely accept. They'd use data points to estimate a person's bottom line before making an offer.
Seriously?
Saved the company millions in equity grants, apparently. It's calculated labor cost suppression using information asymmetry. Really stark.
That efficiency focus plays out in capturing markets, too, especially social media. Facebook's early days are interesting. Zuckerberg and Sean Parker, they really didn't want traditional VC money at first, did they?
No, they were very wary of losing control. Eventually, the Washington Post came in, offering $6 million for 10%, valuing Facebook at $60 million. Parker was apparently ecstatic, told an advisor, take it, close that sucker.
But they held out.
Zuckerberg did. He thought even the later Yahoo bid was too low. He was betting everything on 2 huge product launches happening at the same time. He thought they'd massively change the company's value.
And those were?
The news feed and open registration.
Right.
That was the game changer.
Letting anyone join, not just college students.
Exactly. That wholesale shift, as the sources call it, proved Facebook had potential way beyond campuses. It showed its global appeal. And the news feed. That gave them the tool to capture and curate attention on an unprecedented scale. The bet paid off massively.
But that relentless growth focus, it causes friction, right? Especially after acquisitions, like with Instagram.
Oh, big time. There was a real culture clash there. Instagram had this carefully cultivated image, artsy, curated, focused on high-quality visuals. Facebook, coming in, was all about maximizing growth, user numbers, engagement metrics.
And they started telling Instagram what to do.
According to the sources, yeah. Facebook apparently sent Instagram a list of 20 specific changes they needed to make to grow faster. It caused a lot of tension.
Did Instagram push back?
They did, trying to protect their identity. But interestingly, this clash revealed something important to Facebook. Their own data started showing that the intense pressure on Instagram users to present a perfect, flawless life, it was actually becoming bad for engagement in the long run.
Really? How so?
It was creating anxiety, pressure. And that negative feeling was actually pushing users towards competitors like Snapchat, which felt more casual, less performative. The growth machine was, in a way, stressing out its own users.
Wow, okay, looking forward now. The next big frontier seems to be AI, artificial intelligence, and the battle for dominance there is intensely geopolitical, especially between the US and China.
Absolutely. The sources describe how China built this completely separate internet ecosystem, really between 2009 and 2013. It was fueled by fierce internal competition, a massive rapid jump to 500 million smartphone users.
And the rise of the super app.
Exactly. Apps like WeChat. They aren't just one thing they're messaging. Social media payments, shopping, banking, all rolled into one portal. That level of integration is way beyond most Western apps.
And that gives them incredible amounts of data for training AI.
Huge amounts. Kai-Fu Lee, the AI expert, breaks the development into 4 waves. First is internet AI, think recommendation engines, optimizing clicks, holding our attention. That's already dominant.
Okay, wave 1.
Wave 2 is business AI, using AI for efficiency, replacing paralegals, automating stock trading, helping doctors diagnose illnesses, also already happening.
Wave 3.
Perception AI. This is about digitizing the physical world, teaching computers to see, recognize faces, understand speech, interpret images, think smart surveillance, but also enabling robotics.
And the final wave.
Autonomous AI. This is the big one, the most potentially disruptive. Self-driving cars, autonomous drones, fully automated logistics systems.
So where does the US stand versus China in this crucial autonomous wave?
Well, according to the sources we have, the U.S. currently holds about a 2 to 3 year lead in the core technology for autonomous AI.
Why is that?
It comes down to the sheer difficulty and, crucially, the safety aspects. Building truly reliable Level 5 autonomy is incredibly complex. It requires these dense clusters of world-class engineers, and right now those clusters are primarily in the U.S., especially around places like Google, Waymo, that have been doing fundamental research for years. The engineering bar is just incredibly high, demanding elite talent and massive resources to get it right safely.
So when you pull it all together, what you see is how this massive wealth, whether it's from industry, finance, or tech, inevitably translates into political power, into geopolitical influence, often operating in the shadows through things like dark money networks and influencing corporate accountability.
The Koch network is a really detailed example in our sources. It recounts a specific case involving Koch Industries down in Corpus Christi, Texas. They ended up pleading guilty to a felony concealment of information about their benzene emissions, a serious environmental charge.
And they paid fines.
Yeah, $20 million in fines and environmental projects. But what's telling is the prosecutor's comment at the time. He said, environmental crimes are almost always driven by 2 things, economics and arrogance. And he asserted both were present in the Koch case.
That word arrogance, it echoes back to the 19th century tycoons, doesn't it? A sense of being above the rules because of financial power.
It seems to be a recurring theme. And the Koch network didn't just pay the fine, they immediately channeled that financial power into political action on a huge scale. The sources identify the passage of Obamacare as a key trigger.
A watershed moment.
That's the phrase used. It provided the juice, the motivation for the network to mobilize massively, aiming to flip the House majority in the next election cycle.
And they brought in allies.
Yes. Crucially, the sources mention friction between President Obama, who had called some Wall Street figures fat cats, and those same financiers. People like Stephen Schwartzman from Blackstone, feeling slighted by the administration, apparently showed up at a Koch summit with their checkbooks in hand. Personal grievance and political opportunity merged for the ultra-wealthy.
We see a similar dynamic globally, right? With financial centers acting as hubs for offshore wealth.
Absolutely. Hong Kong and Singapore have played that role in Asia for a long time. After the Asian financial crisis in '97, for instance, something like US $200 billion in Indonesian capital reportedly ended up parked in Singaporean banks.
And Singapore deliberately cultivated that.
Oh, very strategically. The sources detail how, especially when European countries started cracking down on Swiss banking secrecy, Singapore saw an opportunity. They actually increased their own bank account secrecy laws and changed trust regulations specifically to attract global capital.
Including questionable money.
The sources include a leaked email from a banker explicitly mentioning the goal was to attract money, including, quote, corruption money from China. Singapore positioned itself as the new safe, discreet haven as other options tightened up. That nexus of money, power, and, let's say, flexible legality gets even more direct when you look at figures like Victor Bout, the infamous arms dealer.
The merchant of death.
His network was global, shadowy, with connections to multiple governments. But ultimately, he wasn't really controlled by any of them. In the Russian underworld, they talk about needing a krisha, basically a roof, a powerful protector high up in Moscow. Bout was widely suspected of having one.
And governments kind of look the other way sometimes. Even used him.
The hypocrisy was pretty stark. The sources mentioned the U.S. being eager to use his planes in Iraq while pestering his network with limited sanctions. He allegedly flew missions carrying U.S. personnel into Afghanistan.
So his logistical value outweighed his illicit activities, at least for a time.
It seems that way. He was useful, so governments made a sort of tacit bargain. Provide the service, and we won't look too closely at the other stuff. For a while, anyway.
It's worth connecting this back to Russia itself. Putin, early on, actually warned about this kind of concentrated power, didn't he?
He did. Right after the Soviet collapse, he gave this warning about the Russian mentality. He said the danger of totalitarianism comes from the belief that by imposing strict order with an iron fist, we will all begin to live better. But he warned that iron fist would very quickly begin to strangle us. It's an interesting early insight into the cultural leanings toward strong, centralized power that figures like Bout navigated.
And finally, the ultimate power lever. Media, controlling the narrative, shaping the reality these other powers operate in. Roger Ailes at Fox News.
Ailes was explicit about it. He declared television the most powerful force in the world, more powerful than politics. His strategy at Fox was built around creating balance, as he saw it, counter-programming what he perceived as liberal media bias, directly countering the Obama phenomenon, for example.
This isn't new, though, is it? Media titans shaping opinion goes way back.
Absolutely. Ailes was using tactics honed by people like William Randolph Hearst a century earlier. Hearst knew how to build circulation. He created the Evening Journal, aimed deliberately lowbrow, edited by Arthur Brisbane, filled with condensed news, huge headlines.
He understood market segmentation.
Perfectly. Hearst recognized you couldn't reach everyone with just one newspaper. Power came from tailoring the product, controlling what different segments of the population saw and read based on their interests and literacy. It's a direct line to the personalized, algorithm-driven media feeds we have today.
So pulling all these threads together, what these sources really hammer home is that concentrated power, whether it starts with railroads, steel, junk bonds, or algorithms, it's always channeled through intense personal ambition, through individual will.
Exactly. You see this incredible continuity. Think about someone like Cornelius Vanderbilt. Early on, he was actually seen as breaking up older monopolies, championing competition. He had led the rise of competition as a virtue, as one source puts it.
Right, before becoming a monopolist himself.
Precisely. Contrast that with today's titans who control global data flows, capital movements instantaneously. The scale and the tools are vastly different algorithms and dark pools instead of railroads and steel mills. But that core drive for dominance, for victory, it feels very, very similar.
So we've spent this time looking at how these figures build influence, how they reshape economies, societies. What's the final thing for you, the listener, to really chew on?
Maybe think about Steve Jobs again. We talked about his drive. Sources say he confided in friends about having this premonition of a short life that fueled his incredible impatience, his relentless push.
So the provocative thought is, how did that deeply personal sense of urgency, that feeling of running out of time, how did that translate into world-changing products like the iPad? How did one person's intense, compressed ambition end up fundamentally altering the daily habits, the consumption patterns, the lives of billions? That's the scale of impact we're talking about. That personal drive dictating the pace of global change.